India's consumer price index for July cooled to 3.54%. This is the sharpest fall in nearly 5 years, and this was driven by a drop in vegetable prices. However, industrial output growth slowed to 4.2% in June, the slowest pace of growth in 5 months. Latha Venkatesh joins us now with the details. Latha, take us through the inflation fine print.
Yes, that's right. It's a bit of a mixed picture that is coming on the macros, but the more important number is CPI because monetary policy is based on the CPI coming down to 4%. 3.54, hurrah! Does it mean that the MPC will move towards a rate cut? No, because the Reserve Bank had guided that we are going to see a fall in inflation in July, August, September because of the base. Year ago, the July inflation was 7.44. And therefore, the current number was always expected to come below 4. It is transitory. It will move up towards the 4.7 mark as we come to the third quarter, as per RBI forecast. But within this, we need to be happy that the CPI number is below market expectation. Our own poll was 3.64, as you know. And within that, the food inflation, which our poll said would be 5.5, has come in at 5.4. That's also a minor positive. Going ahead, the monsoons have been better than their start. In fact, they are now running at 107% long-term average, as the RBI said. So that would mean that food inflation, the worst, is clearly behind us. Vegetables inflation was the sore point. It was as high as 29% last month in June. Now it's a much more manageable 6.8% year-on-year rise, which means that the worst of the tomatoes and potatoes inflation is also behind us. Pulses is still a sore point, 14% higher YOY, but still better than 16% higher YOY in the month of June. So prices are coming off. The one set of prices that have gone up, or at least the year-on-year number looks higher, is core inflation, up at 3.4% compared to 3.1% in June. That could be because telecom tariffs are getting included. We saw the recent hikes by all the three major telecom companies in the country. And the core inflation will also rise because the base effect is eroding. Core inflation was very high in the first half of last calendar year in 2023. It was ranging from 6 to 5%. But as you get further into 2023, it falls to 4%, and therefore the base will make the core inflation higher. There are not too many fears about core inflation except the base effect, simply because the global force factors, both China and US, seem to be disinflationary at this point in time. Very quickly on industrial output, the number is disappointing at 4.2%. Our own poll was expecting above 5%, but this is not a number that is used for policy. It's an input, one input into GDP, so not to worry too much. The worrying number in the manufacturing, in the IIP number, is manufacturing, which has come in at only 2.6. Within manufacturing, consumer non-durables has come in at minus 1.4. So clearly the consumption wheel is not kicking, and the capex wheel is slowing. It is only 2.4% from 2.9% in the month of May. So it's nowhere near the double digits that it was 2 years ago. It could be a passing phase because the government didn't spend much during election time, but the output side bears watching. Mixed picture from macros, therefore, good news on inflation. Growth, well, a little bit below expectation.